Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella, with additional insight from industry veteran Jordan Kimmel. We'll break down the news, trends, and overall direction of the markets, telling you what's next, investment opportunities, and what to avoid. Now, here are your hosts, Dominick Tavella and Michael Hartzman.
Good evening, everyone. This is Michael Hartzman. Today is January 26th, and I'm here with my partner, Dominick Tavella, for our third episode of the Lebenthal Report. How are you, Dominick?
Doing well. How about yourself, Mike?
Good, no complaints. So another week, and I always measure these weeks, Dominick, by the types of phone calls we get, and you and I always compare notes. And I think the prevailing message this week was, are we in a bubble? Is the market too frothy? Is there going to be a depression? Is there going to be a sell-off? It's been kind of a cascade of this wall of worry that not that the market has, but actually that our clients have. The market's been having a grand old time. And it's really always interesting, you and I always talk about the psychology of the market and investors. So this week's concern is, are we in a bubble? So I'll ask you your opinion. Are we in a bubble?
Yeah, so the markets, as you already touched on, Mike, had a pretty good week last week. Overall, the prior week, the S&P had given back a little bit of the gains, and last week they pretty much got them all back. So we closed at an all-time high today, and the markets overall are looking at the progress of the vaccine and the introduction of that vaccine into our population and the speed of that. And overall, things could be moving quicker and more people could be getting the vaccine. But I think the markets are comfortable with the idea that at the very least, there's a light at the end of the tunnel now, and we just have to work to get there. But this idea of a bubble is still kind of coming up quite often in our conversations with clients and other discussions that we have. And I think there are sectors of the market that are in a bubble. I think there are stocks in the market that are in a bubble. But I think it's hard to argue that the entire market is in a bubble, right? I think we can point at specific situations and go, wow, that makes me nervous, right? But if you look at good core solid companies, we've had the majority of the companies that have reported earnings so far, 80% of them are actually beating their earnings expectations, 80%. So analysts had been pretty euphoric about what their expectations were already. And the markets, individual stocks are beating those numbers. So individual stocks, individual sectors, I think a little frothy for sure. Overall, no, not really. Not really.
I agree for two reasons. One, if we look back at 2019, everyone used to talk about the FANG stocks and how well they were doing. And that was, for those who don't know, Facebook, Apple, Amazon, Netflix, and Google. And they basically carried the market back in 2019, and no one really seemed to be that worried about it. And recently, you are on a call with the portfolio manager. I was on a call with the portfolio manager, and they both said the same thing, and that is that the breadth of the market, meaning the participants of this rally, is getting wider, not getting more narrow. And if they saw that the participation of the rally was only a few stocks, then I think the market would be concerned that we were having a real bubble. And the other part of it is, which we've talked about on the previous two shows, there's still a ton of sectors which have not even participated in this market because of the pandemic. And on every call that we go on with portfolio managers, and even when we talk to Jordan, our own portfolio manager, there's all this pent-up demand of people waiting to get out there and spend money again. So I spent a lot of time trying to convince our clients that I still think the market has a way to go, and there's some legs, because there's still many companies that are not participating in this rally.
Yeah, to your point, Mike, last year, if we looked at the S&P 500, we've spoken very often about it. We've written about it. Large cap growth, particularly technology, just had an amazing run. We call it the stay-at-home stocks that people could utilize. And the rest of the market, and certainly the value stocks, I call them boring dividend stocks, they had a very rough time of it. If you look at the major indices this year, value and growth are up almost exactly the same percentage. So I think we do get some bumps in the road. We've talked about it. We've seen the rollout of the vaccine has not been smooth. There have been hiccups left and right. It could have been handled better. I'm not here about pointing fingers, but we could see that the rollout is going to be fits and starts and stops, and therefore the recovery is not going to be as smooth as we would like. But on the other hand, the trillions of dollars that are sitting in bank accounts. Brian Moynihan from Bank America was on an interview this morning talking that some 80% of the stimulus money that has been given out is still sitting in bank accounts. Consumers can't spend even if they want to, the way they want to, right, Mike? So what happens, and this is a lovely question I'd love you to address, what happens when all this money starts flowing out? What happens when these consumers finally get an opportunity to spend this money? What do you think happens, Mike?
Oh my God. I think all the retirees who love to cruise are not going to be able to book their cruises quick enough, right? I think the Broadway theaters in New York City will be packed again. The restaurants will be packed again. The stadiums will be packed again. So to your point, I think people who have assets and are retired cannot wait to get back to living their life, right? I mean, anyone who whatever age they were in 2020, I think they want to stay that same age again in 2021, because 2020 life was on hold for the whole world, basically.
Yeah, I think we all kind of missed a beat there, right? We missed a year of our life just went away. And unfortunately, we're now topping 400 people that passed away, 400,000 people that have passed away.
Way over that, yeah.
And, a lot of our clients, which tend to be more middle-aged and older, they're looking at their life and they're going, you know what, maybe I need to rethink what I was going to do in the past, and will I be alive? I mean, they're being a little bit morbid about it, but they want to spend. That's the bottom line. They're saying, you know what, I have all this money put away, and it's time to open up the floodgates. And as we remind our clients all the time, the consumer is somewhere between 70 and 80% of the economy, right? So our call is for, rough bumps and bruises probably over the next couple of months. But as the economy opens up, as the individuals begin to get out there, certainly the parts of the economy that have been closed down, I think are going to see explosive growth.
And that's why earnings season has been pretty good so far, right? And I think the forward outlook for many companies is going to be pretty optimistic for the most part, which is another reason why I think the market still has some legs right now.
I think the one thing that still probably frightens people is the political environment. But I would have to argue that so far so good, Mike. It seems like just the rhetoric has died down a little. And I don't know if there's this wonderful spirit of cooperation, but maybe just not as much animosity as before.
Yeah, I think so. We still have this little issue of the impeachment that we have to get through, but
that might be one of the bumps in the road.
Yeah, but I think it's a little anticlimactic because the person they're impeaching is gone. But still, I don't think any of that will affect the stock market. I think the stock market's looking way past that, and that's I'm not minimizing it. It's a serious matter, but I don't think it affects anyone's investment decisions. It certainly will not affect mine or your investment decisions we make for our clients.
What comes to mind is the size of the stimulus package, and clearly the markets were looking for bigger is better. But we're starting to see some rational thoughts coming into the discussion that it looks like the Biden administration might be willing to accept a little bit less money as long as that money's targeted to people that actually really need it. So in the sense of compromise, we might see the stimulus package, even if it's a smaller version, come through. And I think that, again, would be a positive for the market.
I agree. But to your point, I think the stimulus package also should be narrowed, and I don't know how you do this, to people who actually need the stimulus, not to people who are going to stick it in their bank.
Yeah. And again, I bring up the stat that we're sitting with somewhere between $4 and $5 trillion of money sitting in bank accounts, a large portion of that having come from the federal government. And maybe people could not spend it the way they wanted to because of the virus. Maybe they had fear of spending it and wanted to hold on to it tightly until they were more comfortable. But that's an awful lot of liquidity out there, Mike, that eventually is going to come into the economy and maybe into the markets.
Absolutely. I couldn't agree with you more. And you briefly mentioned, the going-ons in Washington, which is a good segue for our first guest tonight, which is a good friend of ours, good friend of the show, Harold Bollaci, who's an estate planning attorney. And every time we have a new administration, it always seems like it's a full employment act for estate planners, because always wondering what the new administration will do. So I'm curious to get Harold's take on that as we come into our next segment.
Look, we both have known Harold for a very long time, and I think you would agree, next to what's going to happen in the markets, the most common question we get is about wills and trusts and estate planning. So I'm looking forward to having Harold and giving our viewers and our own clients a pretty good background on what they should be thinking about. So I think hopefully we're going to have a good segment with Harold there.
Yeah, I mean, not only are they worried about their taxes and their wills and their trusts, but they also worry, is the government now going to take my money? Should I spend it all? So I'm really curious to get Harold's take on that as we come into the break.
My vote, Mike, is spend it all and don't leave anything to the kids. But the kids do object to that advice. So hopefully Harold will tell us how to do it correctly.
Exactly. And we need those kids to stick around as clients. Hopefully they do have some money as well.
Wow.
So with that, we will return shortly, and we'll be back with Harold Bollaci.
Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella. We'll break down the news, trends, and overall direction of the markets, telling you what's next, investment opportunities, and what to avoid. Now, back to the Lebenthal Report.
Welcome back, and welcome to the show, Harold Bollaci, an estate planning and trust attorney in Long Island, New York. How are you, Harold?
I'm doing well. Thank you for having me.
Good evening, Harold. How are you?
Hi, Dominick.
So first of all, Harold, we both wish you a very happy birthday.
Thank you very much.
I cannot think of a better way to spending your birthday than on the Lebenthal Report.
And this is exactly how I want to spend it.
Yeah, with me and Mike. I'm sure that was your first wish.
If you could get me a plate of carbonara, it would really complete the scene.
It'd probably be easier for me to make it for you, but that's
So Harold, let's just jump into this. I was thinking today, that we actually met you when Dominick and I were invited to speak in 2011 for the run-up of the Romney-Obama election. We were asked to speak. You were a guest, and we've been great friends literally since then. So That's been over 10 years. and that election seems so quaint compared to the last two that we've all lived through. But every new administration brings, as I don't know if you heard me saying this in the first break, I apologize. It seems to be the full employment act for estate planners. We start getting calls almost immediately. I read they're going to take away my deduction. I read they're going to take away my money. Should I put my money in a trust? Should I put my money in a mattress? I did read some plans that Biden had over the weekend that were a little disturbing, of really backtracking on some of the estate planning, the estate exemptions that we have now for the inheritance tax. But my experience has been that we always hear these rumors, and I don't think the inheritance tax has ever gone backwards. They've always threatened to lower the threshold, but they never actually have. So let's start there. What is your take with a new administration, a Democratic administration? What is your take on estate and inheritance taxes going forward?
I'm fairly optimistic that the new administration is going to at least hold the line on the federal estate tax regime. And the reason I say that is because estate taxes are very salient political talking points, but in practicality, they affect very, very few people. I'm sure it would not surprise you to know that in 2020, only about 4,100 estate tax returns were filed with the Internal Revenue Service. And of that, pardon?
In the entire country.
In the entire country.
What was the limit, Harold? What was the limit that you were required to file?
The limit is now up to 23 million for a married couple. It's 11.7 million for individuals. So broadly speaking, of the estimated 2.8 million people who passed away in 2020, only about 1,900 decedents' estates paid federal income tax. And it really only generates about $23 billion for the federal government. Yes, that's a lot of money for us, especially for you guys to even have that under management. But as far as the federal budget's concerned, they're giving away $1 trillion at a time. So worrying about trying to upset so many people with a reduction in the estate tax exemption, I just think would be politically foolish. I think most people, we all want to be rich someday. So this is a really salient political talking point, but in reality, very few people have to pay federal estate tax. So I don't think they're going to do very much with it. I hope they don't. I think they'd be ill-advised to do that.
I'm sure you heard a prior conversation with myself and Mike that is probably the most common question we get. If I die, I don't want the government to get my money. And clearly you're saying that's not going to happen, right? So what are the documents that we want to make sure our clients have in order? What's the priority of what documents these people should have lined up so that they don't have to think about this anymore?
Yeah, I think as we begin a new year, it's amazing. It's already the 26th of January, but a new year is always a good time to reflect on your estate plan if you have one. And if you don't have one, it's certainly time to start thinking to an estate planning advisor or attorney. Key among them, basic things like healthcare proxies, living wills, powers of attorney, last will and testament. I hold myself out as a trust and estates attorney, so my preference is for people to do more trust planning. And that's really our goal for our clients is you want to get your affairs in order, you want to be prudent, but you also want to put things in place to promote the efficient administration of your estate, God forbid you pass. You want to minimize the amount of effort your family has to undertake, minimize the amount of expense, and of course, time. So could I share with you two quick anecdotes? The first happens to do with a longtime client of mine, not an older guy, he's 67. He had a stroke last night.
Oy.
And he's been saying for months, just write this down. He left my office about 6 weeks ago, write this down. And I said, you have to sign this So now his family's calling me saying, well, do you have a healthcare proxy on file? Do you have a power of attorney on file? I said, yeah, we've been talking about it for 10 years, but he never signed it. So the answer to that is no. And secondly, as far as estate administration goes, estate administration, which is probate or administration in the surrogate's court where you pass, courts are closed in New York right now. I mean, not entirely, but what used to take me 6 to 8 weeks, this could take 5 or 6 months. So that's 5 or 6 months where your heirs have to try to cover your expenses, and they really don't have an opportunity to begin settling your estate. And that assumes that the will that you submit is accepted for probate and that none of your heirs or family members are challenging your intentions through the court process, which unfortunately is fairly common.
Do you have you seen, as a result of the pandemic, more people anxious to get their affairs in order who may have been procrastinating right along, like the example you just gave?
Absolutely. And I think one of the things that's really gratified me is the desire to do estate planning as a result of COVID has been very broad. So it's not just the older clients. It's not people in their 60s, 70s, and 80s. I'm having a lot more younger couples come to me just to do basics. Whenever I'm talking with young people, my first question is, who's going to be the guardianship of your children? God forbid you and your spouse pass simultaneously. And that's something that requires a lot of consideration and deliberation. So certainly I've seen a definite uptick in people looking to do estate planning and get things written down, because once they're written down, you can revisit it as life changes. This isn't something that's set in stone, but putting pen to paper is very important. And especially, given back when we were shut down, nobody had anything else to do. Sit down, get it done, and forget about it.
Yeah. Let me ask you one follow-up question to that when dealing with young people, because Dominick and I get a lot of calls from young, new parents, newly married. And my advice for years has been, all right, whoever you make the guardian of your children, I don't know if I necessarily make them the person in charge of your assets or the person in charge of your life insurance benefit. They could easily make it the same person, but my advice has always been that they should be two different people. What's your opinion about that?
I completely agree, for several reasons. Number one, I think, to your point, appointing a separate guardian of the person and a separate trustee over money, it establishes a set of checks and balances. It's another set of eyes, and I think that's very important. But it's also a way to include both sides of the family, because you don't always, if all of the decisions are going to the wife's side or the husband's side, you don't want to make people feel like they've been left out. So maybe the wife's side, her sister becomes guardian of the minor child, and on the husband's side, his brother becomes the trustee, and then they get to work together. And at least it keeps, theoretically, it tries to keep the families together and engaged in the minor's well-being, both health-wise, educationally, but also financially.
Hey, Harold, I often get new clients coming in, and we ask to bring their documents, and more often than not, they don't have anything. And the number one issue I get is it's really complicated and it's really expensive. And I would argue that both those comments are wrong. For the average person, the basic will and healthcare proxy and durable power of attorney, it's neither complicated documents nor expensive. You want to just touch on that one a little bit?
I completely agree with you. I always tell people, don't overthink it. Don't make this harder than it has to be. Who's going to be your healthcare agent? Who's going to be your agent under a power of attorney? If you pass away, where are your assets going to go? And keep in mind that a last will and testament and a trust, they only pass assets that don't transfer by operation of law. So you gentlemen manage a lot of people's money. You have retirement accounts, individual brokerage accounts. Those accounts have beneficiary designations on them. So they fall outside of a last will and testament because they pass by operation of law. And that extends to life insurance, annuities, and most other financial instruments. So a lot of times, a last will and testament is dealing primarily with people's primary residence and any other assets that might not have a beneficiary designation on them, including some personal possessions. But normally it's the primary residence that's the biggest issue under a last will and testament.
You know, I wish we had more time, but just real quick, you mentioned personal residence. What do you recommend for a couple in a second marriage as it relates to last will and last will?
This is such a great question, and we could talk for days on it. The value of revocable or irrevocable trust planning to second marriages. In the business, we call them blended families. And the idea here is that you don't want to disinherit, either intentionally or accidentally, your spouse's children from another marriage. So it's very important when doing planning for blended marriages that, God forbid, one spouse passes. I like to include what I call trigger language, which makes assets that have been put into trust irrevocable upon the death of the first spouse. We certainly wouldn't want to create a scenario where husband or wife passes and the surviving spouse says, I never liked his kids anyway. They didn't come and visit him while he was sick. They're out. That probably doesn't reflect the decedent's original intent, and it certainly doesn't reflect their joint intent when they sign those documents. So putting a trigger in there to lock up what they've put in jointly is a very valuable tool for blended marriages.
Harold, I think we could have this conversation all night, but we are up against a break and you have to go celebrate your birthday. So thank you for joining us.
Best
Thanks
wishes,
so much for
Harold.
having me on.
Thank you so much. Can't wait to have you back.
Thanks, Dominic. Thanks, Michael.
Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella, with additional insight from industry veteran Jordan Kimmel.
And welcome back to the Lebenthal Report. I'm Jordan Kimmel, the Chief Equity Strategist and Portfolio Manager, and it is an absolute pleasure to bring on really one of the most respected guys I know on all of Wall Street, Peter Kenny. Thanks so much for joining us, Peter.
Thank you for your kind words, Jordan. I'm thrilled to be here.
Terrific. And we have a few minutes to really dig a little bit deeper into some things. But, Peter, there's a lot of unusual activity, and who else to bring in but a 20-year member of the New York Stock Exchange. 7 years you were over at Knight Capital as the global market strategist. And I think right now there's a lot of discussion about how important boards are to companies. I know you're the lead independent director over the Bank of Ozark. So with all these countercurrents going on, it's just such a pleasure to have you on. And thanks again.
Well, honestly, I don't go on every invite that's thrown my way. I'm thrilled to be here. So to me, this is an honor as well. Thank you.
Right. And I know you don't really look for too much publicity. The only way we get to hear from you, frankly, that I know of is Kenny's commentary, which you've been really kind enough to allow me to jump in with you. And every week it comes out. For years I've read it. There's not a lot of contributors. It's you and Sam Stovall jumps in a lot. And that's a pretty good company. So I want to thank you and tell all the listeners, try to subscribe to it. It comes out Monday morning and gives you real good insight on what's happened, what's happening, and what to expect. So I really do appreciate, coming on there. So let's jump into the markets right now, Peter, because we've been in the business a long time. When I got in the business, treasuries yielded 8%, 10%, munis yielded 8%. We're in this environment of lower for longer, these sub 1%, tough ways. How do you generate? I think a lot of what you do at Bank of Ozark has helped them on the fixed income side, I believe.
Well, that's
how do you deal with this market?
The focus at Banco ZK is fixed income. What I do professionally is separate from that. I'm the lead independent director at Banco ZK, but away from that, in my line of business, which is my 9 to 5, so to speak, I do a lot of strategizing like you. I do a lot of writing, a lot of commentary work, and a lot of consulting. In this environment where it's lower, longer, you have to have an approach that takes advantage of the inefficiencies in the market, and you have to be extremely methodical about it. When I got into the market in 1982, the Dow was trading at 727. I've seen my fair share of things and have managed to live through them, thank God. But it's been tough, and right now I've never seen anything like what we're seeing now. These low rates are forcing investors to do irrational things in some respect. In that you see a lot of the growth stories really dominating the headlines. It makes me a little uncomfortable, to be honest with you. And yet there's sound reason for some of it. We are not only in lower rates for longer, we're in an environment that is dominated by a pandemic, which is rewarding technology companies, particularly software companies, that can take advantage of how that new workforce materializes over time. So you're seeing some really dynamic growth in some of the companies that deliver on that deliver on the green revolution, that deliver on electricity distribution, charging, things of that nature. So if you're in one or two of those verticals, you're doing fabulously well. And if you're in the broader market in terms of indices, you're not doing all that bad. But you do have to wonder, at what point do these real high flyers and the market as a whole pull back 5-10%? Law of averages would suggest that needs to happen certainly in the next quarter, the next 3 months.
Right. Well, Pete, I think a lot of people would be happy if the pullback in the high flyers was only 5 or 10%. We've lived through a lot more than that. And, at Lebenthal, it's a very conservative firm. It's known for generating income. I am on the equity side. I have a model that really talks about, facts, the thing that when we first met the most trustworthy companies, but I'm also involved in something right now, the dividend growth strategy, where we're using the magnet model not to look for the highest dividends, but the best balance sheets with the best history of dividend growth. And what do you think about that kind of strategy?
I love that strategy. Your strategies are really rooted in the long-term truths of the market. They're rooted in where value is over a long period of time. And over a long period of time, those are precisely the companies, the management, the discipline that you want, because those companies are going to outperform in the long term, and they're also going to outperform in the middle term, in that even if there's choppiness in the market, those companies will be rewarded for their discipline, because long-term investors and short-term investors both are always looking for companies that can manage their balance sheets well, companies that have a lot of liquidity, solid balance sheet, strong corporate culture, leadership from top to bottom and bottom to top. Those things matter, and they really matter when things get dicey and choppy in the market. We've seen that.
Right. I couldn't agree anymore. It sounds like you were reading out of my playbook, Peter. And so what's difficult, I think, right now is people are watching the market. They're watching certain companies move so quickly. And so I really want to ask you, as a member of the exchange, and seeing some of these, the most dramatic short squeezes I've ever seen in my life, there's something going on under the current, and maybe the market acts a little different. Margin maybe that's going on. I mean, this is unusual. Can you jump in on how abnormal some trading activity has been lately?
Well, in order to understand some of this unusual behavior in terms of price action, you have to go back a few years and understand how things were unbundled in terms of regulation on the exchanges. when I was on the street, when I was on the floor of the New York Stock Exchange as a very young member, I was a member in 1987. I had just become a member before the crash. You used to have to be able to sell on a plus tick or a zero plus tick. And you know what I'm talking about.
Yes.
Now, to the average layperson, what does that mean? Why does it matter? Well, now that you don't have to short on a plus tick or a zero plus tick, you can sell on a straight minus tick or a zero minus tick, or let's just keep it to a zero minus tick. Mm-hmm. What's that's doing is driving volatility into the market. And I don't think that investors have been provided sort of the best advice on that. I think that that's driven volatility, and it's driven a tremendous amount of whipsaw action in the market. You see these squeezes that we're seeing just recently in the market. I mean, these things it is really something to look at. And of course, that's the opposite side of that deregulation. You would not see short squeezes like we're seeing if you still had that zero plus tick rule in the market. It's the counterbalance to that shift in regulation, which shed that, regulation in terms of short selling.
Peter, not a lot of people have had that, behind the scenes that you've had. And frankly, you grew up in the business as a kid. And I really have to just mention, your dad was one of the most respected guys on the street. And you followed in his footsteps, Peter. He'd be very, very proud to see what you've accomplished. But you're seeing things, you could talk about things that most people don't really understand. Some people have been talking to me about, there was an article, in fact, in the New York Times today about option trading leading the issuers of the options to go buy the stock, and leads to a cascading issue. And can you talk about that for a minute at all? Are you familiar with that?
I am familiar with that, and that's an inefficiency that must be looked at. The market is constantly changing, and the inefficiencies that are born out of creative thinking and people looking for yield, return on their investment. This is a classic example of where, and I'm not a big regulator guy, okay, but this is a classic example where I think regulators need to just take a look at who's being disenfranchised by this process and who is actually who's able to monetize this process. The general public isn't able to monetize this public to the extent that the insiders are. And that inequity, I think, really is crying out for at least some examination.
Yeah, I mean, I think it needs a lot of examination. And I think that the struggle and the key that I'm trying to remind everybody is not to get distracted by some aberrant behavior of a couple issues. People saying the market is either rigged or it's crazy, or it's a bubble. I think if you systematically and discipline, look through the balance sheets and create a disciplined, diversified portfolio, you could tune out a lot of the noise, and the noise is what gets you. I made a comment in your commentary this week about Mr. Market, and remembering he does get grumpy. He does give you opportunities. And so, Peter, I will share that both Dominick and Michael, who are running Lebenthal, are also veterans. They knew you were coming on. They wanted to step in and ask you questions. So if we can get the engineers to bring Mike and Dom on, if they've got something to ask you. And I just really want to say that the market is founded on dividends, growth, balance sheets, real things, not just charts. And I think too many people, when I try to show them the market, I had interns, they would gravitate to the charts and they didn't want to do the hard work. But there's Dom and there's Mike, and let's see what they'd like to jump in on. So, Peter, thanks for the time. I love you having you on.
Thanks for having me.
Hey, Peter, we're running low on time, so I just want to jump in quick, if I may. So, and as Jordan said, we're both, myself and Mike, have been in the industry for a very long time, dating back to the early 80s. But this last decade we went through, and I'm still scarred by March of 2009, we've seen exceptional returns in the major indices. And my sneaking suspicion the next decade is not going to be quite as good as the last decade. Maybe you want to touch on that a little bit?
I think that that's a great call. I would refer to that as the reversion to the mean. And I've written about that in my note. I think you're right. I think we're going to see some of those extraordinary returns come back down to earth. I'm a long-term bull. I'm a huge advocate for very disciplined investing. And to me, you may see some bull markets within the market. You may see some verticals within the market outperform the broader market and give those really rewarding returns. But generally speaking, the broader market there has to be a reversion to the mean. Hopefully it's orderly.
Peter, real quick, and thank you for being on the show. You mentioned in the beginning of the segment, interest rates lower for longer. And I always tell my clients the intended consequence that the Federal Reserve would never admit to was kind of hurting people into the stock market.
Yes.
Why, when they keep interest rates this low. So just real quick, do you have an opinion on that?
You hit the nail on the head. And that's where bubbles are created. When fiscal policy or monetary policy is aimed at one thing, rates lower for longer to instill an appetite for risk ends up being taken in another vertical, and that's equities. Equities are primary beneficiary of this low interest rate environment. There's no question people are looking for yield in terms of dividend in equities. They're also looking for price appreciation in equities. There's no question about it. You're spot on, and that has always been a problem. Unintended consequences.
Right. Thank you, Peter.
If I can jump on that with the last 30 seconds, and it's really the savers, right, that are really paying for the recovery.
And
it's
the
people
seniors
that have been fiscally responsible and have money savings in the bank or want to buy fixed income bonds. That lower interest rate that they're earning is really the fuel they're paying for the recovery.
Right.
Spot on. It sounds so incredibly unjust, and it is.
Right. The back of senior citizens. Absolutely.
Yeah.
So let me jump in and remind everybody, it's Kenny's commentary that is available. It's complimentary, and goes to the top desks around the world. And it's free for his comments, and I've been contributing. So everybody should really jump on that and get a little insight for Monday mornings. It's not even every day. It's just once a week. And Peter, you're putting out great information. I'm really honored and happy to be helping you with that and adding whatever I possibly can.
Thanks a million, Jordan. You're absolutely super valuable. Love having your contributions. Extremely valuable. And what an honor it's been to be on with you guys. You guys are such gentlemen and clearly understand markets.
Peter, thank you
Peter.
so much. Again, appreciate the time you spent with us.
Thank you.
All righty, we are up on a break, so we'll take a quick break. We'll be back more with the Lebenthal Report.
Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella. We'll break down the news, trends, and overall direction of the markets, telling you what's next, investment opportunities, and what to avoid. Now, back to the Lebenthal Report.
Welcome back to the Lebenthal Report. I'm Michael Hartzman along with Dominick Tavella. And Dominick, I just want to follow up on the last point that Peter made, which I don't think you and I talk enough about. And I don't really think it gets enough press in the media. Everyone talks about how wonderful and low interest rates are. And low interest rates are wonderful. If you have a mortgage, if you own a business, if you need to borrow money, if you need to build a new factory, low interest rates are fantastic. However, the people who really suffer when interest rates are low, and as Peter said, are lower for longer, are really the seniors, are really the retirees, are really the people who now are forced to take risks that they never really intended to. And you and I, we talk about this all the time. You know, both of us probably get 1 or 2 calls a day. I have 50 grand, I have 100 grand, I have 150 grand sitting in the bank. I made $8 in interest. Can you do better? But we could do better, but we also have to add an element of risk to their portfolio that they don't have at the bank. So it's just interesting, and I just really wish that a little more time was spent on that in the media when they celebrate how wonderful
Mike,
low
I have
interest
to
rates
tell
are.
you, you are spot on. I know I've brought it up in some of my public interviews that I've done, but it gets very little press. If you are a borrower, then these very low interest rates are a gift, right? And that's what the Fed is trying to do, is provide the fuel to the economy so that the engine can start rolling again. But there's no free lunch. Those lower interest rates, the other side of that equation is that if you're a saver, and ironically, if you've been fiscally responsible your entire life and have money put away in the bank or have money put away in municipal bonds or in other forms of savings, you actually get punished. The earnings on those accounts falls through the floor. So the benefit to one side, the borrower, is offset by the benefits that, or the lack of benefit, to the person that actually has been responsible and has savings put away. And it absolutely does force people to take risks that I don't know that they would take if all things were equal. So not enough time gets spent on that subject. And I appreciate you bringing it up and Peter spending a few minutes talking about it.
Yeah, because look, we both have the same question. My first question is, when a client asks me that, is like, well, how long has this money been in the bank? And why is it in the bank? And do you really want to take that money now and add some element of risk with that money? So, but as I said to Peter, I don't think it's an unintended consequence. I actually think the Fed knows exactly what they're doing when they keep interest rates this low, this long. Eventually, they're going to wear people down, and they're going to take risks at a later stage in life that they really never intended or wanted to undertake.
Well, and sort of making a bad situation worse, we now have politicians, both parties, that are saying, oh, we can afford to borrow even more because interest rates are extraordinarily low. And it's sort of like just a snowball feeding downhill, getting bigger and bigger and bigger as our national debt gets bigger and bigger and bigger. Look, I don't know how this all ends, but I think Peter and Jordan, ourselves, we're concerned, right? There is some concern out there, and I think justifiably so.
Yeah, absolutely. And then you mentioned, the deficit. That's a whole other can of worms, right? I mean that has not been talked about in probably 4 or 5 years. And the deficit, even before the pandemic, had grown in the first 3 years of the last administration, and now it's through the roof. And eventually that's going to have to be dealt with. Someone's going to have to pay that bill.
Someone's going to have to pay that bill, and as seems to be the public mantra, it'll be our children and our grandchildren. But look, there's always unintended consequences, these kinds of actions. We've seen it on a global scale. We hope and pray that our politicians today are a little bit smarter, wiser, learn their lessons from the past. But we still have a very important role in this, and that's managing risk in our clients' accounts and their portfolios. And it's a very sacred responsibility. We take it very seriously. So to the extent that we're able to hold clients' hands and walk them through these very volatile times, that's a role we take very seriously, Mike.
No, I agree. And when interest rates go up for real, it's going to be some sticker shock, especially for younger people or people in their 40s who literally in their entire working life, the last 10 or 12 years, have had basically interest rates below 2 or 3% the entire time. And eventually there's going to be a comeuppance where interest rates are going to be 5 or 6 or 7%. And there's so many people out in the workforce and building families who've never dealt with that.
So one of my favorite mantras is reasonable rates of return over a reasonable period of time. And if you think about interest rates lower for longer, and you think about stock returns the next decade not being quite as good as the last decade, we didn't say not positive, just not as good. I think clients need to have more realistic expectations about what the next decade is going to look like. And that doesn't mean we won't have reasonable rates of return. They just may not be off the charts like prior years.
Right. But for now, Peter is 100% correct. It's lower for longer. The Federal Reserve is on the record, unless there is runaway inflation, that they're not going to raise interest rates for the rest of this year and probably for the rest of next year, unless some anomaly happens.
And so shorter term, I think we've expressed this to our own clients and on these calls that we're cautiously optimistic for the balance of this year. We do have a little reserve just in case we can afford to take advantage of some dips in the market. But as the vaccine enters the markets and the economy, and the economy should start to open up. So cautiously optimistic.
Yeah. Well, again, I think we're just about out of time, and I'm sure the next week will present us with another plethora of discussion topics. Exactly. So have a great evening, and
Thanks, Mike.
get a great
And
show.
to our guests, thank you again for a terrific show. Looking forward to next week.
Thanks for tuning in to the Lebenthal Report. Dominick, Michael, and Jordan will be back for our next program, airing next Tuesday at 2 p.m. Pacific Time and 5 p.m. Eastern Time on the Voice America Business Channel. Until then, have a great week.